After studying this module, we shall be able to explain the various short-term and long-term sources of finance available to the company, focus on the role of commercial papers and factoring as emerging sources of finance, elaborate the spontaneous sources of finance, understand the benefits and cost of each source, highlight the various modes of bank credit, and discuss the securities used by banks to grant credit.
Hello students, as we know that working capital is very important for smooth running of the operational activities of a firm. But now the question arises, how to finance this working capital? There are three sources of working capital financing: short-term, long-term and spontaneous source. Short-term sources provide funds for a period generally less than 1 year. Long-term sources provide funds for a longer period, more than 1 year. Spontaneous sources are not specifically taken up by the firm but eventually arise during the course of business.
To begin with, let us first discuss the short-term sources of finance. Basically, there are four types of short-term sources to finance working capital. These include trade credit, bank credit, factoring, and commercial papers. Trade credit is the first most important source of short-term finance. Almost 40% of current assets are financed by trade credit only. After this, bank credit is mostly used by the firms. The two other short-term sources are commercial papers and factoring of receivables. These sources have developed in the recent past. We shall discuss these sources in detail one by one. The first type of short-term finance is trade credit. It is a credit that firms get from suppliers when they buy raw material and defer the payment. Thus, it arises in the normal course of business. It is mainly important for small firms as it is difficult for them to get loans from banks. Trade credit can be shown in the balance sheet of the buyer firm in three forms, which depends on the type of credit agreement between the firm and the supplier. First is sundry creditors, that is, when credit is received informally without any legal document on an open account basis. It is shown as sundry creditors in the balance sheet. Second is bills payable, where a formal agreement is made. The buyer firm signs a bill to get credit from the supplier, which appears as bills payable in the balance sheet. The last one is promissory note, where the buyer firm makes a formal written promise to make payment at a specified future date. The formal agreements are made when the supplier does not trust the buyer firm. Trade credit provides many benefits. The first benefit is that it is easily available. Unlike other forms, getting credit from suppliers is not very difficult. It is of special importance for small firms who find it difficult to raise funds through other sources. Second benefit is its flexibility with respect to sales of a company. As the sales increase, purchases from suppliers also increase, which automatically increases the credit taken and vice versa. Lastly, it is an informal source. It does not involve any legal formalities and negotiations. Thus, it is quite attractive as compared to other sources. But apart from having benefits, it has costs too. But the cost of trade credit is not explicit, it is an opportunity cost. Sometimes suppliers offer a discount if we make cash payments or if we pay within a specified period. In such a case, if we go for credit, we shall not get that discount. Thus, the cost would increase and the discount which could have been availed would become an implicit cost. Let us now proceed to the second important source of finance, which is bank credit. It is an institutional source of finance. Banks represent the main source of finance in India. We may get credit from banks in various forms. These are overdraft. It is available only to a firm which has current account in that bank. In this case, firms can withdraw from their current account an amount in excess of their balance up to a specified limit. This extra amount becomes the credit. The firms need to pay it back within a prescribed time and also pay interest on daily basis. Cash credit. In this case, the firm opens a cash credit account in the bank. Now that firm can withdraw amounts periodically within the prescribed limits. In this case also, repayment has to be made within prescribed time together with interest thereon. However, in this case, the borrower firm has to keep assets as securities against credit facility. Discounting of bills. In this case, firms give their bills to banks and in return, banks give them the amount receivable after deducting some amount which is called discount. On maturity, banks themselves collect the amount from debtors. This form is encouraged by RBI. Loans. In this case, the borrower firm gets a loan from the banks which it puts in its current account. After this, the firm can withdraw the amount as and when required in installments. The firm has to pay the interest on the entire amount and return it at maturity. Working capital loan. This is an extension of loan. Suppose in case of an emergency, firms require some finance which is above the already granted loan. In such situations, banks give working capital loans and firms have to pay comparatively higher interest on such amount. It is mainly meant for contingencies. Letter of credit. It is an indirect source of bank credit in which firms gets finance through the buyer. In this case, the buyer of goods gets a letter from the bank called the letter of credit. The firm sells goods on the basis of this letter, according to which if the buyer fails to make payment within a specified period, the bank will make the payment and thus provide finance. Let us now discuss on what basis banks provide such credit to firms. Banks generally take some securities from the firms before granting credit to safeguard themselves. The various modes of securities required by banks are hypothecation. Under this mode, borrower gives the security of movable property, generally inventories, to the banks for raising credit. The goods remain with the borrower in physical form. However, banks retain the right to sell the goods if the borrower defaults in making payments. Pledge. Pledge is almost similar to hypothecation. However, in case of pledge, the physical possession also remains with the bank till the repayment is done by the borrower. If the borrower defaults in making payments, the bank gets three options: sue the borrower for the outstanding amount, sue for the sale of goods pledged, and sell the goods after giving due notice. Lien. In this case too, goods are kept as securities. In case of lien, banks have the right to retain possession of goods till dues are cleared by the borrower firms. Lien is of two types: particular lien and general lien. In case of particular lien, banks have the right to retain goods until dues related to those goods have been paid, whereas general lien means right to retain the possession of goods until all the dues have been paid. Banks generally give credit on general lien. Mortgage. In this case, immovable property like land, machinery, etc., is kept as security with banks. Physical possession remains with the borrower, but banks get a legal right on the property. These are taken as collateral security for financing of working capital by banks. Charge. In case of charge also, immovable property is given as security, but in this case, physical transfer also takes place together with the legal right. Thus, the bank gets a charge on such property. Let us now proceed to the third short-term source, commercial paper. It is comparatively a newer and emerging source of finance as compared to traditional sources like bank credit and trade credit. It was introduced by RBI in 1989. Commercial paper is a promissory note issued by the borrower to a financial institution to get short-term credit. The credit may be obtained from banks, insurance companies, mutual funds, and other financial institutions. It is an unsecured source of financing working capital. That is, the borrower firms are not required to keep any security against credit. RBI is the sole regulator of commercial paper market in India. Only listed companies with net tangible worth and fund-based working capital of rupees 5 crore or more with good credit rating can get credit through commercial papers. When commercial papers are issued, firms get a discount amount as credit, but they need to return the amount at face value. The extra amount they pay becomes the interest, which is tax deductible. However, the interest rate is generally less as compared to rate of borrowing. Let us now discuss the benefits and limitations of commercial paper. The benefits are, first of all, it provides an additional source for raising funds which can be used when bank credit is not easily available. Second, as discussed earlier, the rate of interest is lower as compared to that of borrowings from banks. Hence, it is a cheaper source as well. Finally, from the point of view of lender, it is quite safe as the maturity period is lesser and credit rating of the borrower is high. Thus, the risk of default is very less. The limitations of commercial paper are, first of all, its maturity cannot be altered. It cannot be extended in case the borrower wants the funds for some more time. Similarly, if the borrower wants to make repayment earlier, the period cannot be shortened. Thus, the time frame is very rigid. As we have already discussed, RBI puts various regulations for issuance of commercial papers, which makes it possible only for financially sound companies to get credit through this source. Now we come to the last source of short term finance, that is, factoring. In this case, the firms sell their accounts receivables to a factor who is the agent of a financial institution. The factor then provides finance to the firms against those receivables. The debtors then directly make payment to the factor. In case of default, factor may bear the risk himself or pass it on back to the firm. Apart from financing, factors also help in collection of receivables, maintain accounts of debtors, and provide consultancy services to firms. The two bank-sponsored organizations which provide the services of factoring are SBI Factors and Commercial Services Limited and Can Bank Factors Limited. After discussing in detail about the various short-term sources of finance, we now proceed to spontaneous sources of finance. They are also received for a short duration of time. However, they differ from short-term sources in the sense that they are not specifically taken up by firms, rather they eventually arise in the course of business. Mainly, there are two types of such sources: accrued expenses and deferred income. Accrued expenses are those expenses which are outstanding on firms. These include goods or services that have been received, but payment is not yet made, like accrued salaries, taxes, bills, etc. Thus, the firm in a way retains that amount as credit. It is an interest-free source of finance because the firms need not pay interest on the outstanding amount. However, payments are made by the firm for such expenses within a short period only. On the other hand, deferred income is the income which a firm receives in advance without providing goods and services. Thus, without giving anything, the cash with the firm increases. It is also interest free. However, as goods have not yet been sold, such amount does not become revenue, rather becomes a liability until goods are delivered. The last source is the long-term sources of finance. These are mainly used by firms if they need funds for a long period of time, say more than 1 year. There are basically four types of long-term sources available, that is, equity shares, preference shares, debentures, and term loans. Let us discuss these sources one by one. Let us first discuss equity shares. These provide funds for a long duration of time. The common equity shares are issued to public at large. The shareholders get ownership rights in the company. Like other sources, this source also has its benefits and costs. In case of equity shares, no repayment is required. It is an ongoing source of finance. Dividend payment is also completely discretionary on the part of companies. At the time of liquidation also, the claims of equity shareholders come at the end. However, it has certain costs as well. It is a very costly source of finance as the cost of issuing shares is very high and the dividend paid is not tax deductible. The next source of long-term finance is preference shares. They are similar to equity shares but also have some features of debentures. Thus, they are also called hybrid securities. They differ from equity shares in the sense that preference shareholders get no right of voting in the company, they have to be repaid, their dividend payment is mandatory, and they have a claim on liquidation of the company. After shares, the third source of long-term finance is debentures. They represent a long-term loan for the company on which it has to make fixed interest payments. This source attracts the companies mainly because of two reasons. The right of the company is not shared with debenture holders, and it is comparatively a cheaper source of finance as the interest is tax deductible. However, it also has certain limitations. The company is required to pay fixed interest and repayment on maturity. If the company fails, it can lead to liquidation also. Thus, it is quite risky. Debentures can be of different types like secured, unsecured, convertible, irredeemable, etc. The last source of long-term finance is term loans. These are directly obtained from banks and other financial institutions. They are also known as project financing as they are mainly used for projects of expansion, diversification, etc. These loans are always obtained against some securities given by the firms and involve regular payment of interest. These are a cheaper source of finance as interest paid is tax deductible. On maturity, companies need to pay back the outstanding loan amount. Banks providing the loans also get the right to restrict the working of the company. But together with benefits of lesser cost, this source also has certain limitations. Out of all the given sources, the companies make their choice on the basis of their requirements and cost benefit analysis of each source. Let us now summarize what we have learned in this module. In this module, we have discussed the main three sources of finance, namely short-term, spontaneous, and long-term. Short-term sources provide finance for a period of less than 1 year. There are four types of short-term sources, which are trade credit, bank credit, commercial paper, and factoring. Bank credit may be obtained in various forms, that is, overdraft, cash credit, discounting of bills, loans, working capital loans, and letter of credit. Banks generally take securities from the firms for these loans. These securities may be taken in different modes, which include hypothecation, pledge, lien, mortgage, or charge. Spontaneous sources are not specifically taken up but arise in the normal course of business, like accrued expenses and deferred income. Last are the long-term sources, which provide funds for a period of more than 1 year. These include equity shares, preference shares, debentures, and term loans.